There is a defense stock sitting in the market right now that the President of the United States personally holds, that 6 sitting members of Congress have been quietly buying, that the company's own CEO just put $3 million of his personal money into, and the stock is down nearly 50% from its highs, down 50%, while insiders are loading up. Now you tell me, when was the last time you saw that combination of signals line up in the same stock at the same time? Because in 30 years of studying businesses and markets, I can tell you that this specific convergence, a world-class business in a government-guaranteed growth industry, with insider buying at every level from the CEO to the president himself, at a price that reflects maximum pessimism rather than realistic fundamentals. That does not come around often. Most people are going to watch this video, nod along, do absolutely nothing, and then wonder 2 years from now why their portfolio looks exactly the same as it does today. Don't be that person. Pay attention right now. Before I go any further, I need you to subscribe to this channel, and I'm not asking nicely. Every single week on this channel, we break down opportunities exactly like this one. Real numbers, real analysis, the kind of institutional-grade research that hedge funds pay 6 figures a year to access. You are getting it for free by clicking one button. If you are serious about building wealth, and you walk away from this channel without subscribing, that is not bad luck. That is a decision you made. So make the right one, hit subscribe, and let's get into this, because what's coming next is going to completely change the way you look at this sector. Let me tell you what's actually happening in the world right now. Because if you don't understand the environment, you cannot possibly understand why this stock matters. And I don't mean the headlines. I mean the real structural shift that's been quietly building underneath the surface while most retail investors were busy chasing AI software names and semiconductor stocks. The United States defense budget has just crossed $850 billion. Not projected, not proposed, crossed, signed, allocated, and the current administration's publicly stated direction is toward $1 trillion annually within the next budget cycle. Now, before you shrug and say defense spending has always been big, I want you to understand why this specific moment is categorically different from any defense spending environment of the last 4 decades. Because here's the thing, for most of the post-Cold War era, defense money went into hardware, ships, planes. Thanks, the same 5 or 6 prime contractors built the same platforms they had been building since the 1980s. That era is over. The Pentagon has publicly acknowledged in writing, in doctrine, in procurement strategy, that the wars of the next generation will be decided by software and intelligence, not by who has the most steel in the water. Battlefield AI real-time surveillance networks, integrated command and control systems that can synthesize thousands of data streams into a single, clear, operational picture in seconds. That is what modern defense spending is being redirected toward. And that redirection represents hundreds of billions of dollars flowing into a completely different category of companies than the ones that dominated defense investing for the last 30 years. And that's not all, because on top of the American spending surge, you've got every NATO ally on the planet being formally told that 2% of GDP on defense is now the floor, not the target. Germany just blew past that number. Poland is approaching 4%. The UK is expanding. Every single one of those allied nations needs defense technology systems that are interoperable with American platforms, which means a significant portion of European defense expansion flows directly into American defense technology companies. Then you add Ukraine, which has been the most consequential real-world stress test of modern military technology in a generation. And what Ukraine proved beyond any reasonable debate is that the demand for intelligent surveillance systems, drone networks, and battlefield data platforms is effectively unlimited in active conflict environments. And then you add Taiwan, and you realize that this is not a temporary spending cycle. This is a permanent structural elevation of global defense technology demand that has a decade-long runway at minimum, and it creates what I call government-guaranteed revenue streams, a category of business where your customer is a sovereign government with a legally mandated budget and a multi-year contractual obligation. And that changes the risk profile of the investment in a fundamental way that most retail investors have never properly thought through. So what is the company and what does it actually do? Because I am not going to make you sit through 20 minutes of buildup. The stock is Palantir Technologies. And I know some of you just rolled your eyes because you've heard the name before and you think you know what it is. And I am telling you right now with complete confidence that you probably don't, because the financial media has done a spectacularly poor job of explaining what this business actually is at an operational level. So let me do it properly. Forget the jargon, forget the tech buzzwords. Here's what Palantir does in plain human language. Imagine you are running a military operation and you have 10,000 different data streams pouring into your headquarters simultaneously, satellite imagery, drone feeds, signals intelligence, ground sensor data, enemy position reports, supply chain status, weather communications intercepts, casualty tracking. Every single one of those streams is coming in at the same time in different formats from different systems that were never designed to talk to each other. Raw data by itself is not intelligence. It is noise. The entire challenge of modern warfare at the command level is turning that ocean of noise into a clear, actionable picture faster than your enemy can. That is precisely and specifically what Palantir's software does. And it has been doing it inside the operational infrastructure of the United States military and intelligence community for over 15 years. Their government platform, called Gotham, is not a tool that agencies use. It is the infrastructure that agencies are built around. And that distinction matters enormously when you are thinking about this as an investment, because there's a word in investing that you always want to hear when you're evaluating a business, and that word is switching costs. The switching cost of removing Palantir from a military intelligence operation is not measured in dollars, it is measured in compromised national security. It is measured in years of operational vulnerability while a replacement system is built, tested, and deployed. No defense secretary in the history of this country has ever accepted that kind of strategic risk for a software cost saving, and none ever will. That is a moat. That is one of the deepest, most defensible competitive positions I have seen in any industry, because it is not built on being slightly cheaper than the competition or slightly better at some technical benchmark. It is built on the fact that the operational security of the United States government now depends on this software continuing to function without interruption and beyond the government business, which is the anchor. Palantir has built something called their Artificial Intelligence Platform, AIP, and this product is doing something genuinely significant that most of the analyst community has been slow to appreciate. Every large organization in the world right now is trying to figure out how to actually deploy AI in a way that is useful and secure rather than just interesting and experimental. The government cannot plug classified intelligence networks into a consumer AI product. The data security requirements are too stringent. The classification levels are too complex. The operational stakes are too high. Palantir built a platform specifically designed to deploy AI agents inside secure, classified, and sensitive environments where data never leaves the customer's controlled infrastructure. That capability does not exist at the same level of maturity and proven operational deployment anywhere else in the market right now. Their commercial business is growing at over 55% annually because corporations are figuring out the same thing that the government figured out 15 years ago, that Palantir's platform does something no one else does, and once you build your operations around it, you do not leave. Now let me walk you through the insider activity, because this is the part of the story that made me sit up straight when I first saw it, and I think it will do the same for you. I want to be clear about something before I get into this. I am not someone who normally puts a lot of weight on what politicians do with their investment portfolios. Most of the time it is not particularly informative, but there are specific conditions under which congressional trading activity tells you something genuinely important. And those conditions are present when the members of Congress doing the buying are sitting on the exact committees that oversee the contracts, the budgets, and the classified programs that the company depends on for its revenue. That is not noise. That is the loudest possible signal. We have members of Congress sitting on the House Armed Services Committee, the Senate Intelligence Committee, and the Defense Appropriations Subcommittees who have disclosed purchases of this stock in recent filing windows. These are people who receive classified briefings on defense technology procurement priorities. These are people who vote on the specific budget line items that fund this company's government contracts. These are people who, in some cases, directly oversee the agencies that are this company's largest customers. When the person who writes the check starts buying the stock of the company, the check is you pay attention, full stop. And it doesn't stop there, because the President of the United States personally holds over $1 million in this stock. And it was his administration that signed a major new government platform deal that dramatically expanded the company's federal footprint. Now, when the president owns the stock, his administration is actively expanding the business of the company he owns stock in. That is a data point that is very difficult to dismiss, regardless of how you feel about the politics. And then there is the CEO, Alex Karp, just put $3 million of his own personal money into the stock at current prices, $3 million out of his own pocket, not out of a compensation plan, not through an automatic trading schedule. He actively bought shares with his personal capital because he believes that stock is worth more than what the market is currently pricing it at. And here's what I want you to think about when you hear a CEO buying their own stock. CEOs sell shares for dozens of different reasons. They need liquidity. They want to diversify. They have a mortgage. They want to buy a boat. There are 100 reasons a CEO might sell. But there is only one reason a CEO buys stock in their own company with their own money, and that reason is that they believe the stock is going to go up. That is it. There's no other explanation. So when you combine congressional buyers with committee-level access to defense procurement intelligence, a president who holds the stock and whose administration is expanding the company's government contracts, and a CEO putting $3 million of his own dollars into shares at current prices, what you have is a convergence of informed buying that I find very difficult to explain away as coincidence. Now let's talk numbers, because this is where I actually live, and this is where I think the case becomes the most compelling. I want to walk you through the financial picture in a way that is honest and complete, because I'm not here to sell you anything. I am here to show you what the data says and let you make your own decision. Palantir's trailing 12-month revenue is approximately $3.5 billion, growing at roughly 30%. Year over year, their free cash flow margin has expanded to above 30%, which means for every dollar of revenue they generate, they are keeping 30 cents as actual cash. That is an extraordinary number for a company growing this fast, because most businesses have to sacrifice margin to sustain growth, and Palantir is doing both simultaneously. Now here is where most people make a critical mistake when they look at this stock. They see the current price-to-earnings ratio. It looks high relative to a traditional value benchmark, and they immediately conclude the stock is expensive and move on. That conclusion reflects a fundamental misunderstanding of how to value a growth business. The question is never, what are you paying for last year's earnings? The question is always, what are you paying for the earnings this company will generate over the next 3 to 5 years? When you apply that forward-looking framework to Palantir, consensus analysts estimates project earnings per share growing at approximately 40% compounded annually over the next 3 years, driven by government contract expansion, commercial AI platform adoption, and the operating leverage that comes as the business scales. If those estimates are even half, right, if the company delivers 20% earnings growth rather than 40%, the valuation at current prices begins to look genuinely reasonable relative to the quality of the business and the visibility of the revenue. The metric I find most useful for evaluating growth stocks is the PEG ratio, the price-to-earnings ratio, divided by the earnings growth rate. When a company's PEG ratio is approaching 1, it means you are paying a fair price for the growth you are getting. Palantir's forward PEG, using consensus growth estimates, is approaching levels that historically have been associated with attractive entry points for high-quality growth businesses. But the number I keep coming back to, the number that I think is most underappreciated by the market, is the remaining deal value, which is the total contracted revenue that customers have already committed to paying, but that hasn't been recognized on the income statement yet. This is not projected revenue. This is not management's optimistic forecast. This is signed contracts, money that is already committed, and that contracted backlog is growing faster than current period revenue, which tells you the growth rate is not slowing down. It is accelerating. The balance sheet is clean, zero debt, approximately $4 billion in cash and short-term investments, a share repurchase program that management has been actively executing. This is not a speculative startup burning through investor capital hoping to figure out a business model someday. This is a profitable, cash-generating, government-contracted business with a 30% free cash flow margin, a 40% projected earnings growth rate, a multi-billion-dollar contracted backlog, and a management team that is putting their personal money in alongside yours at current prices. I'm going to do something now that I think separates real financial analysis from the promotional content that fills most of the investing internet. And I am going to tell you plainly and honestly why this investment could go wrong. Because anyone who presents an investment idea without laying out the bear case is either not smart enough to see the risks or is deliberately hiding them from you. And either way, you should not be listening to them. The first and most legitimate risk here is valuation risk. Not that the company is overvalued today necessarily, but that if the growth rate disappoints even modestly, the market's reaction will be severe and fast. Growth stocks at elevated multiples do not decline gradually when they miss expectations. They collapse. A company growing revenue at 30% that delivers 23% in a single quarter can lose 30% of its market value in a single trading session, because every institutional model that owned the stock was built around the higher growth assumption, and the miss triggers a cascading reassessment of every future period. You need to understand that dynamic and size your position in a way that you could survive that kind of drawdown without being forced to sell at the worst moment. The second risk is contract concentration. A meaningful portion of Palantir's government revenue comes from a relatively small number of very large contracts. And the loss or restructuring of even one major contract would have a material impact on the reported growth rate. Government contracts are also subject to the continuing resolution problem. When Congress cannot agree on a full appropriations budget and operates on a continuing resolution instead, new contract awards slow dramatically, and Palantir's new business pipeline compresses during those periods even if the existing contracts remain intact. The third risk is competition from the large technology platforms. Microsoft, Amazon, and Google are all pursuing government AI contracts with enormous financial resources and existing relationships across the federal customer base. Palantir has substantial advantages in security clearance, infrastructure, and operational maturity that cannot be replicated quickly. But underestimating trillion-dollar technology companies as competitive threats is a mistake I have seen investors make repeatedly throughout my career, and it never ends well for the people making it. Those risks are real, and they deserve to be taken seriously. But here is why I believe the risk-reward at current prices still favors the bull case. The defense spending tailwind is structural and bipartisan. It does not change based on election outcomes because both parties have demonstrated consistent willingness to expand defense budgets when the geopolitical environment demands it. The switching costs in the government business create a revenue floor that is genuinely difficult to dislodge. And the commercial AI platform business creates an optionality value that is not fully priced into any consensus model I have seen. The risk is real. The math, done honestly and conservatively, still points in the right direction. Here's where I leave you, and I want every single word of this to land. You just spent 25 minutes getting a level of analysis that most retail investors will never receive in their entire investing lives, not because the information is secret, not because it's complicated, but because most people never sit down and do the actual work of understanding a business from the inside out, the moat, the financials, the insider activity, the industry tailwinds, and the honest bear case all laid out together so you can make a real decision rather than an emotional one. And now you have it. So what are you going to do with it? Because here's the reality that I have watched play out 10,000 times over the course of my career. Most people who watch this video will find it interesting. Some will say they're going to look into it. A smaller number will actually pull up the financials and read them. And an even smaller number, the ones who actually build wealth over a lifetime of investing, will do the work, form a conviction, make a disciplined decision with a defined position size and a defined exit strategy, and execute it without second-guessing themselves every time the stock moves 3% in either direction. The difference between those groups is not intelligence. It is not access to information. It is not luck. It is discipline and the willingness to act when the evidence supports action, rather than waiting for the certainty that never arrives. Subscribe to this channel, because next week we are going to keep going deeper on exactly this kind of analysis. Share this video with one person in your life who you think is serious about this, and leave me a comment right now telling me whether you own the stock, whether you're watching it, or whether you think the bear case is stronger than I gave it credit for. I read every single one. Now go do the work.